Have you ever wondered how a thriving national economy, seemingly stable and prosperous, can suddenly face a dramatic financial crisis? It is a complex process often rooted in seemingly benign policy choices, yet with far-reaching consequences for millions. Thailand's financial collapse, which ignited the 1997 Asian financial crisis, originated primarily from a combination of a fixed exchange rate policy, massive capital inflows, and an ensuing asset bubble fueled by excessive and poorly regulated lending. This created a structural vulnerability that made the economy ripe for a crisis. The core mechanism was Thailand's decision to peg its currency, the baht, to the United States dollar. This fixed exchange rate, combined with a relatively open capital account, made foreign borrowing incredibly attractive for Thai businesses. They could borrow easily in United States dollars, convert to baht, and invest in the booming domestic market, seemingly without exchange rate risk. This massive influx of foreign capital primarily flowed into speculative real estate and stock market ventures, inflating an asset bubble. Unfortunately, much of this lending was short-term, in foreign currency, and extended by domestic financial institutions to long-term, domestic currency projects. When the property and stock markets began to cool and foreign investors grew nervous, a currency mismatch became a grave problem. As the baht came under speculative attack, defending the fixed peg drained Thailand's foreign reserves rapidly, forcing the government to eventually float the currency and seek international assistance. This scenario perfectly illustrates what economists call the impossible trinity or trilemma. A country cannot simultaneously maintain a fixed exchange rate, allow free capital movement, and conduct an independent monetary policy. Thailand had chosen the first two, effectively surrendering control over its domestic interest rates and money supply, which exacerbated the speculative bubble. The lack of robust financial regulation also allowed for significant moral hazard, where lenders and borrowers took on excessive risks knowing they might be bailed out. Understanding these origins helps us recognize the crucial role of sound macroeconomic policy and robust financial regulation in maintaining economic stability. It highlights the dangers of sustained capital inflows when not effectively channeled into productive investments, and the inherent risks of currency pegs in a globalized financial system. These lessons continue to inform policymakers worldwide in their efforts to prevent similar financial turmoil.